The market is acting bullish again. That matters. Price is one of the cleanest signals investors get. But price going up does not automatically mean risk went away. It means the market is willing to pay more than it was before. So when the tape turns bullish, the job is not to cheer it blindly. The job is to audit it. Bullish does not always mean all clear. A rally can be real. It can also be fragile. So the better question is not, why are stocks green? The better question is, what actually changed underneath? Most investors stop at price. Stocks are up, so the story must be better. But price is only the first signal. It tells you what investors are willing to pay today. It does not prove that earnings improved. It does not prove inflation cooled. It does not prove yields relaxed. And it does not prove market breadth expanded. Price often moves first because markets discount the future. Fundamentals usually confirm later. Sometimes the market is repricing genuine improvement. Other times it is repricing mood. Sentiment can improve because investors were too negative. Fundamentals improve when revenue, margins, cash flow, and guidance start moving in the right direction. The audit is about separating those two forces. One is about what investors feel. The other is about what businesses are actually proving. Those are not the same thing. That is why every rally needs an audit. Not emotionally, mechanically. Ask what changed in earnings, rates, inflation, breadth, and risk appetite. If the answer is not much, the rally may still be real, but it may be driven more by sentiment than confirmation. A healthy bullish setup usually has confirmation underneath the move. Earnings expectations start to improve. Companies show real demand, stable margins, pricing power, and better guidance. That is earnings quality. It is whether revenue is durable. It is whether margins are holding. It is whether cash flow supports the story. And it is whether management guidance sounds stronger or weaker than before. Inflation pressure cools. That matters because inflation affects rates, input costs, consumer spending, and valuation math. Then yields stop pressuring the market. Yields matter because they compete with equity valuations. When yields calm down, growth assets usually get more breathing room. And finally, breadth expands. That means the rally is not being carried by only a few mega-cap names. More sectors participate. More stocks confirm the move. That is the cleaner, bullish version. Earnings improve, inflation cools, yields relax, breadth expands, leadership broadens. Now here is the fragile version. A rally can be real and still fragile. Stocks rally, but earnings expectations do not really improve. Valuations expand before profits do. That creates vulnerability because the market is paying more for the same earnings base. The multiple goes up before the business case gets stronger. A few large companies carry most of the index. Yields stay sticky. Inflation risks remain alive. And investors start chasing because they are afraid of missing the move. That kind of rally can still go higher. Momentum can last longer than people expect. But it has less cushion. If the next earnings report disappoints, or yields move higher, or inflation comes back into focus, the market can reprice quickly. That is the difference. A bullish tape is useful. It should not be ignored. But a bullish tape without confirmation is not the same as a durable uptrend. The sharper question is this: what risk did the market stop pricing? Did investors stop pricing recession risk? Did they stop pricing inflation risk? Did they stop pricing higher for longer rates? Did they stop pricing earnings weakness? Markets do not only move on good news. They move when expectations change. If investors were positioned for something ugly, and that ugly outcome starts to look less likely, stocks can rally hard, even if the economy is not perfect, even if earnings are not booming, even if risks still exist. It means the market was braced for something worse, and the evidence came in less damaging than expected. The market does not need perfect, but it does need expectations to improve. And investors still need to know whether better than feared is enough to support the next leg higher. If expectations improve for 1 week, that can support a bounce. If expectations improve across earnings, rates, inflation, and breadth, that is a stronger foundation. So what should investors watch next? First, earnings quality. not just whether companies beat estimates. Watch revenue, margins, cash flow, and guidance. Second, Treasury yields. If yields rise again, valuation pressure can return quickly. Third, market breadth. Are more stocks participating, or is leadership still narrow? Breadth helps show whether confidence is spreading or staying concentrated. Fourth, commodities and inflation signals. Oil, metals, shipping, and input costs can change the inflation story fast. If input costs rise again, margins and rate expectations can both come under pressure. Fifth, credit and consumer stress. If credit weakens or the consumer starts to crack, the bullish story becomes more complicated. This is not about being bearish. It is about being disciplined. Strong markets deserve respect, but every rally should still be tested. Bottom line, the market may be bullish again, but the real question is not whether stocks are green. The real question is what changed underneath. If earnings, yields, inflation, and breadth confirm the rally, that is constructive. If sentiment is running ahead of fundamentals, the setup is more fragile. Do not chase blindly. Do not fight the tape blindly either. Audit the move. Separate signal from mood. Follow Apex Wealth AI for practical market intelligence without the hype.